All right, this is going to be recorded. So one thing I always say is if you're watching this and you're new to options or this particular strategy, watch it again relatively soon after, especially with this one. This has got a lot of nuances and rules that need to be applied in order to increase your probability of profit with this. This options workshop is going to be on the short butterfly, and anytime you're dealing with the short butterfly, it may seem like an easy strategy to set up. I mean, just at first blush it is, but you can set this strategy up where legitimately at order entry you can be locking in a loss, and that's the last thing we want to do. We actually want to create a situation where we've moved the probabilities in our favor, increase our chances of success, and I'm going to go through all the rules and the ways to design this strategy in order to increase your probabilities and hopefully make you more profitable when using this strategy. And let me get over a couple of things real quick. My name is Wilkinson. Some of you may recognize me from CNBC, Fox Business, or the Wall Street Journal for my geopolitical, economic, and market analysis. Been trading my own money for well over 20 years. I actually started out in college trading with a psychology degree and then decided, you know what, I really kind of like this whole trading aspect of finance. So I switched my degree from psychology and moved it into finance. And I actually, after moving to Chicago, after graduating, I told people on the floor, you know, I think my psychology degree is better suited for this type of environment than even my financial degree, despite the fact that a lot of people were asking me about what the economic numbers actually really meant. A lot of those guys just traded movement and technical analysis and stuff like that. Didn't even really look at what the overall economic picture was. It was kind of funny in the beginning there. These big traders asking a runner what the economic numbers meant. Anyway, like I said, I've been trading my own money. Started out trading in college, and I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. Let's get over this disclaimer real quick. This says any opinions, news, research, and analysis or other information contained here or material provided by ProTrader Strategies and or associate companies or employees is for general commentary and does not constitute investment advice. The reason why I can't give you investment advice is because I don't know what your risk parameters are. I don't know what's in your portfolio, and it would not be fiscally or fiduciary responsibility for me to tell you what to do. So I avoid that at all costs. As a matter of fact, we're here to teach you how to swim, not here to swim for you. And if anybody out there is telling you guys, hey, you need to go out and buy this, you need to really be wary of that kind of investment advice. You know, do a little soul searching is what I always say, and make sure that it's appropriate for you. And bottom line is, do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. You can also follow me on Twitter at Wolfman's blog, or follow us at ProTrader Strat. The ProTrader Strat website really throws out a lot of deals and wisdom from the trading perspective. I sometimes will throw out, especially we're getting back into earnings season again here, I'm going to be throwing out what my earnings trades are if I don't get them out on the daily market commentaries, or at least try to, and or if I have a tendency to cover something late in the day, I try and remember to go out to Twitter and throw that out, like with my Lululemon trade I covered today. So you can follow us on either one of those two links there. How doing, JQ? How you guys doing? Trevor, Farshed, Shady, giving you shout outs. You guys are throwing it out there for the Wolfman, throwing out to the Wolfman on there. Funny. All right, so anyway, this is going to be on the short put butterfly. If you remember last week, we did the short call butterfly. We're going to be doing the short put butterfly in this series of butterflies. There's so many different ways to play around with this butterfly, and that's why I thought it was really important, especially in this type of environment we're in with low implied volatility, or at least medium implied volatility. This is a strategy that can be implemented in this type of environment relatively easily. Short put butterfly, our market assumption is outside the wings. We want a big move in either direction. Now, with the short call butterfly, we actually wanted that market to go down. With the short put butterfly, you actually kind of want this market to go up. So it is a big move, but you know, if you needed to have a bias, and we all kind of have a little bit of a bias to it, we thought it was going to be a big move. This one, you would really want it to move upwards, believe it or not. It's these butterflies on the short side are a little counterintuitive in that regard. And the reason why is because we are going to be having a put that is in the money at the implementation of this product. So at the end of the day, the reason why you kind of want to have at least a leaning towards the upside, you know, you don't really have to have a market direction, but if you started having one like, hey, I think this is going to have a big move, and I think the odds or whatever to the upside, that's when you would do the short put butterfly. If you thought the odds were to the downside, you would implement the short call butterfly. The reason why is we want this in the money put to actually go out of the money, just so that we can get away from somebody trying to put us that stock. So, you know, if you had a bias, you know, that's the way I kind of look at it when you're setting this up. But anyway, to build it out, like I said, we're going to be selling one in the money put, buying two at the money puts, and then selling one out of the money put. And, you know, we're going to try to make this to where we're as close to risking one to make one. If you can risk less than what you have the possibility of making, that is a bonus. And a rule of thumb that I usually have is on a $50 stock, it's going to be like $2 to $3 wide wings. That's away from the base ones, those at the monies. So we're going to try and go $2.50 to the upside, $2.50 to the downside to implement this. And then on a $100 stock, you know, you kind of want it to be $5. You know, it doesn't always work out that way, but that should be your mindset when going into this. You know, we want to have these two shorts as close to at the money as we can. You know, the closer the better. That increases your chances of it moving outside those wings. You would never really want to do this with like a you know, a $20, $30 wide strikes on a, say, a $20 or $30 stock. That just is pretty unlikely. So try and keep those wings as tight as you can. Always start as tight as you can, then slowly incrementally move them out a little bit to achieve that 50% ratio in a sense, or collect a bigger credit than that 50%. So if it was, you know, a $5 wide, you'd want to at least collect $2.50, and if you could collect $3, that's even better. And kind of started on this already. Pick the right underlying. This is really important, you guys. I mean, there's stocks out there that are commonly traded on the open market that just don't have a lot of open interest in the options. And then you can find some that, you know, you don't see very widely talked about on mainstream media, say Micron Technologies or something like that. Believe it or not, they have really tight markets. So make sure when you're looking in the options chain or the option montage that the bid offer on any given put or strike that's relatively close to the at the monies is within 10 cents wide bid ask. Now, another thing that I look at, that's on a stock that's on $100 or less. You want that bid ask to be tight, 10 cents wide or less. And then on something that's bigger, a rule of thumb to look at is if it's a $300 stock or a $500 stock, you just move the decimal place 3 ticks to the left, and then that's how wide those bid asks should be. So on a $500 stock, it would be like 50 cents. You know, on a $1,000 stock, it would be about $1 wide on the bid ask on any of those stocks that are just slightly out of the money. Deeper in the money, those bid asks are going to be a little bit wider, and we'll see that happen with this put butterfly. That's the other aspect of that is, you know, we'd like to see this market move actually up to get those in the money puts out of the money, because you start seeing a little bit tighter bid ask once they go out. The deeper in the money they go, they get a little bit wider and there's a little less activity. So that's another reason to, you know, kind of look and see if you have a slight bias to one way or the other. But at the end of the day, we just want a big move happening. And then picking the right strikes, I kind of mentioned this. It's an in the money, an at the money, and an out of the money. That seems pretty easy to come up with. But the fact of the matter is the right strikes is determined by following that major rule with the short put butterfly that we need to collect at least 50% the width of those strikes. So on a $5 wide butterfly, meaning from the at the monies to the in the money, that needs to be at least $2.50 wide, or collect at least $2.50 from that $5 wide wing. And picking the right duration, the perfect scenario around this is as close to 35 days as you can get, 45 to 35 days, because we want to get in here, get this theta decay happening, and if we can get it, the directionality, like this market goes up, we're going to see that happen a lot faster. The further out in duration you go, yes, it gives you a little bit more time to be right, but at the end of the day, you are going to have wider bid ask on those, wider wings, if you will, in order to achieve that 50% the width of those strikes. So, I've been looking at a lot of different scenarios because we're really close to going out to the March contract from the February, but the February is really as close to the 35 days as we can, because we're right there at around the 28 days. It's really closer to that 35 days, and I'm finding that it's a little easier to achieve that 50% the width of the strikes here, rather than going out that extra, one more tick further out on the wings, or another $5 wider or something like that. So we can find some in the further duration, but for the most part I've been finding a lot right in here that work out. So try and shoot in the future as close to 35, 45 days as you can, or whichever is closer. Right now we're right in the middle, so I'm going to go closer probably. And then picking the right environment. This is a situation where we're looking for a 15 to 30%, or a IV percent that's somewhere between 15 and 30%, I should say, which there are a lot of stocks out there in that range right now, especially right after you've seen some of them have earnings. They will drop right into that range for a little while, and that would be a good scenario for that, because they could have some major movement going on there after, because a lot of times even right after we have the earnings event, you'll start seeing them have calls and stuff like that. That's really when the CEOs can kind of start talking. They're not really allowed to talk real close heading into those binary events, so you can start seeing some big movements afterwards. And then knowing your exit strategy before entering the trade. Because this is a low probability trade, any type of butterfly for that matter is a lower probability trade. Any, I should say, quote unquote butterfly where you have equal distant wings is a lower probability strategy. So we need to know what our exit strategy is in there, and because it is a low probability strategy, I usually look to take right around 30% of my max profit. So in that one example I was talking about, if our wings are $5 wide, meaning from the at the monies to the in the money, or the at the monies to the out of the money puts, if that's $5 wide, we collected $2.50. That means our max profit is $2.50. We're going to be looking to take around somewhere between 65 and 75 cents for that trade, and then take it off. So if I collected $2.50, you would subtract the 75 cents from that, and get your $1.75. Buy it back for $1.75, that is. All right, so, and another thing to do is just multiply what your credit is times 0.75 or multiply it times 0.65, and that will give you what your target is on that. And I don't have a problem in putting in that as a GTC. So Karen, yeah, you can put that in as a GTC as soon as you've entered the trade. I don't have any problems with that, because sometimes you might not pay attention. You could have gotten hit on it. So that is definitely possible. So your max profit on this trade is the premium received. Anytime you're collecting a credit, that is your max profit. Your max loss on this, it is a defined risk strategy. So we know what our max loss is getting into this strategy. It also, because it is a defined risk strategy, we can do this in an IRA. So despite the fact that we are selling at the money, or sorry, an out of the money call and an in the money, or sorry, an out of the money put and an in the money put, it is offset by those two longs that we are implementing with this butterfly. So it is a defined risk strategy. Somebody were to, you know, put you that stock, you still have that long put that you could put to them. So it makes it IRA appropriate, which is very important for a lot of you guys out there. And or if you have a smaller account, this is good for some of those smaller accounts as well, because it is defined risk and you wouldn't be risking everything in your portfolio. All right, so this is usually the time where I throw it out to you guys in the questions box. Is kind of how we'll communicate back and forth. So if you have any stocks that you want me to check out, we'll roll through the rules that I have for this strategy. And, you know, it's a little bit easier to kind of get an idea of going through our checklist to make sure that it fits those rules and that it would be a good stock to implement. We'll even possibly be able to find some that could be setting us up for a loss in the very beginning, hopefully. So we'll have to see. So start throwing them out in the questions box. That's how we'll go about this. We could even, since I've got Lulu up here, we could start out with that. Is it hard to find these trades, Pete? Yes, it is hard. When, you know, you can set up a butterfly in any stock easily. Absolutely, you can do that. But you can also set it up for a loss immediately as well. If you're paying a debit for this spread, that means you've locked in a loss. You know, you could do in some cases, you can do like a $2.50 wide butterfly and you're only collecting a quarter. That means your potential profit is 25 cents and your potential loss is $2.25. So that means that your risk way outweighs your reward. So what we're trying to do is flip those cards and make it where we're collecting more than 50%. So yes, it is hard to find a good stock to fit with this strategy. It's not going to just fit with everything. It's a little easier with the put butterfly than it is with the call butterfly. The call butterfly is much more difficult just because there's usually less premium, I guess, in the calls than there is in the puts. What is the benefit over just buying a vertical spread, Wayne? Great question. Theta decay is not going to affect you in the same way as if you buy a vertical spread. Also, if volatility goes down with your vertical spread, then that's going to hurt you. Also, if you aren't directionally correct with your vertical spread, that's going to hurt you. With this one, this is kind of one of those ones, you know, kind of like Lulu right here. It's like, where's Lulu going to go? You know, you don't really have any market direction here. It's pretty oddballish. You know, one would think that it might want to cover this gap in there and make a big move. So that might be a situation to look at it. usually I like to do these around a situation where you would see it kind of like we used to call it on the floor. Whenever you'd see these real tight ranges for a long period of time, it was like the rubber band getting wound really tight on like one of those old airplanes where you spin the propeller, and the longer you spin that, wind that rubber band up, the tighter it gets, and when you let go, the propeller is going to spin faster if you've wound it 1,000 times versus if you wound it 10 times. So it's going to unravel a lot harder. It's built up energy in a sense. How do you scan for this spread or this option strategy, I guess, is I think what you're saying. One thing I do is I start, like I said, with the rule behind this is to shoot for these ones that are in the somewhere between 30 and 15 for a regular stock underlying. If it's an ETF or something along those lines where it's a basket of them, I'm willing to go a little bit lower on it, but I have found that the best case scenario for this is right around that 15 to 30 IV%, which is what this is over here. And this is also the implied volatility, and it's the implied volatility is just a percentage of this metric. As a matter of fact, it's where the current IV is you have a numerator and a denominator. In the numerator, it's where the current IV is minus the low IV mark, and that sum is divided by the sum of the high mark minus the low mark, and that gives you the percentage in that way. So the easiest way, one of the ways that you can do this is go into the trade window and set it up with, you can go into the single and you can set it up as a butterfly just to give you an idea as to what it is going to be. Like for this one, it's a $2.50 wide one. One thing with this is it makes it a little bit harder to adjust it, but you can kind of get ballpark figures for it. But with the put side, you can see that these two are giving us 50 cents at best case scenario and 72 cents best case scenario. So in that regard, you are going to be looking at much less than the rule of thumb of 50% the width of the strikes. We need to, on a $2.50, collect at least $1.25. So that wouldn't work. That's one way to do it to get an idea. But usually I just go in and build everything out for the most part. I look at for some stocks that I think are going to are due for a big move, or I think it looks like they're in that tight range and have been wound up really tight, and start looking at it. So in this regard, you know, we're at 67 and a half for all, the closest to the at the money. You know, if the underlying's trading 67.32, we'd look at this one is the 67 and a halves. You're going to buy two of those, and then hold down the control button. So you click it, hold down the control button, and since we know that the $2.50 ones aren't going to work, we need to look at the $5 wide ones. So go to there and then sell those. It's $5 wide. We're only collecting $2. I need to at least collect $2.50. So in that regard, we are risking more than we are able to make. The probabilities are really against us there. So I would kick that one to the curb and I'd just move on. What is the difference between the short butterfly and the straddle and the strangle? This is very similar to the straddle in a sense. The long straddle is when we pull up the Analyze tab, you'll be able to see that. We can show how they're very similar, but this is defined risk in a sense, where the straddle and strangle are not defined. Can I post my Twitter handle again before you leave? Thanks. Yeah, Rick, I can't. It's pretty easy. It's at Wolfman's blog. If you're collecting less premium, why do it? Why not do another strategy with more premium? Exactly. So that's the thing, is for this one, it wouldn't fit this strategy, so I'd move along. If I wanted to do something in Lulu and I really wanted to do something in there, then I would have to look at a different strategy. We'd go down, look at the IV percent. It's 42. I had on a strategy in there where I was just short the 75 calls in there and covered them because I just took advantage of the high implied volatility that was in there well after the earnings event. So I got this volatility crush happening well after the earnings with nothing going on. It just started getting higher implied volatility, and boom, I got to take advantage of that. Allowed me to get way out above this gap basically with the premium I collected. So even if it went up and just touched that gap, closed it, I was still had my break even above there. I think I originally collected like 70 some odd cents for it. So that's why I did that trade. So yeah, you have to, if you really want to do something around a particular underlying, and you're trying to figure out what kind of strategy to implement this or implement around this, you need to go through all the rules that I talked about with some of these other stocks. It's a 42 IV percent. It's right there in the gray area with something like this, where it's just below that 50 threshold for selling options premium on most of my other rules for my short premium. But this is why I like to do the butterfly between 15 and 30, because anything below 15 is usually where I start to look at buying options premium, and anything above 50 I sell it. This is in the sweet spot right in between. So that's why I wanted to talk about this one. So we're trying to find something just for this particular strategy. The one thing to keep in mind, you guys, is always implement a lot of different strategies. Don't be a one-trick pony. You want to be able to have several different kinds of strategies going on in your portfolio. Don't just always do straddles and strangles, iron condors, iron butterflies. You always want to have a lot of different things going on. As much as I hate to do premium buying strategies, I implement some of those sometimes because you need to have a lot of different things going on in order to take advantage of different scenarios that could happen. So you always need to throw something on that. How did you create your watch list? Trevor, great question. I actually have a full webinar on it. But for the most part, what I do is when I find a stock that really meets the criteria of a tight bid ask, if it's below $100 and this stock, I don't even care what the stock is, if it's got a tight bid ask within 10 cents, that goes on my watch list. Of course, I do have some on there that don't meet that criteria, but those are usually ones that are usually easily played for on earnings. You'll see a lot of them get tighter bid ask on earnings, and or I just want to keep an eye on the stock for whatever reason. So that's, for the most part, how I've created that. I just find a new stock or hear somebody talking about it, I'll go look at it. If it's got tight bid ask, it makes my list for sure. And then especially, some of them I only look at for just earnings. Do you do any short-term trades, weeklies? I do, especially on earnings. That's usually when I'm going to be doing the weeklies, Steve. So, but for the most part, I look at more of the longer duration strategies. I mean, believe me, when I was on the floor, I did shorter term strategies all the time, where I was doing in and out within a day for the most part. But since leaving the floor, I've migrated from doing those shorter term ones to a little bit longer term. Do you pay for options? I'm having a heart attack. Why? Because I say I pay for options. I do sometimes. As a matter of fact, there's a low implied volatility strategy or thing down here, stock I should say, and I have a real directional assumption, then that's when I'm going to be paying for it. I'm not going to be selling options premium anytime down here where the ID percent is at its lowest point it's been in the last year, because the probability is that option premium is, or the options ID is going to expand. So if the ID expands on me and I bought that premium, then I can be directionally wrong and still make money on it, or at least not lose a whole lot. So in that, yeah, that's the time that I'm going to be buying options premium in a sense. Sound good? The sound is cutting in and out. Is it cutting in and out for everybody else? Sometimes, Trevor, if you log off, log back on, it has a tendency to clear that up. All right, so back to this strategy. Let's look at a couple of different underlyings. We can look at Adobe, since this one's not really going to fill out Adobe. You know, Adobe is over $100 stock, and look how tight these bid asks are. I mean, 3 cents wide. That's really good. Closest to the at the money is the $110 strike, because we can see the underlying's trading at around 110-ish, right in between there. So that would be the closest one. So we hit the buy, hold the control, gets us to, okay, the control button doesn't want to work. And then for this one, we're probably going to have to go $10 wide, just because it's over $100 stock. And let's just see if it works. So $6.70. It's a $10 wide, so that $5 would be the minimum credit. Anything over that is gravy, so we're getting $1.70 over that minimum. So the next thing we can do is try and tighten up those wings a little bit. Go to the 115s and then the 105s, just to see if it fits the rules. So we got a $5 wide wings, and we're only collecting $2. We need to at least collect $2.50. So that part of the fly doesn't work. So, you know, if you think it would go outside of 120 or 100 to get close to your max profit, which would be 120 way up here and 100 down here, that would be your thinking. I would probably wait, you know, with the market profile. Anytime you have the market profile, it gets out of here. It has a tendency to kind of pop. So we could see that happen on the 120 on the upside, but I'd probably rather wait for it to come back inside of here and then implement a strategy. So it's not really fitting the rules either. So it's cutting in and out for you also. Not really, I don't know what's happening. Is it Bobby and Chris? Farshed, yes. I don't know what's happening. That means it's on my end probably. Everything seems to be working fine on my side. It's okay now? All right. All right. All right, so let's move along. So for maybe my computer crashes or something, I don't know. So I'll do a couple that I've vetted just so that we can, what are you doing with the control button? Ground control to me. I'm not doing anything with it. I'm staring at it right now, though. Got a big old mic right in front of me. It seems to be working all right. I don't know. I don't know if my Camtasia is cutting it in and out or what's happening right now. I'll have to try and diagnose that in a minute. So I'll try and pick a couple real quick that I vetted for you guys. So BBBY was one of them, Bed Bath & Beyond. There's no earnings. That's one other key to this. We don't really want to implement this, you know, with the earnings going in there. We would rather not necessarily see implied volatility expand on us. You know, the best case scenario would actually to see the implied volatility stay relatively the same or decrease with this one. And Bed Bath & Beyond just recently had their earnings, so they won't have their earnings until the end, basically. They're one of the very last ones to release earnings. So, you know, I think there's going to be something like in April, just based on here. It's probably going to be somewhere in April. So we know that we're going to have at least a couple clean months. If they give us the March, we could look at the March in this one, and they're not going to. So that's another reason to default to this one. So the last trade on this was 40.68-ish. So that's going to put us at this $40 strike. We're going to buy 2 of those for every one of the shorts that we do. So we'll look at the $5 wide. You know, obviously if we could look at the shorter one, we would do that, but because I vetted this one already, I know it's not possible. So $5 wide, we got a $3 credit. That is the scenario we're looking for. So then we can do the Analyze tab on this one just to see what it looks like on the Analyze tab. I know a lot of you guys like to look at it just to get a visual. So there we have it. So you can see right here it's trading now. Our upside is right here. So as soon as it's trading up and above the $45 mark is where we have achieved our max profit of that $3 in a sense. And anytime it's gone down below that $35, that's going to be our max profit to the downside. The last thing we wanted to do is to come down and pin right here at $40. So we want at least some kind of movement. And then to figure out your break even on this trade is when you take that $45 minus the $3. That gives you the $42, as you can see here. And then on the downside, our $35 plus that credit received puts us at the $38 mark. So, or sorry, yeah, it should be 38. Oh, there we go, $38 mark. Yeah, I'm rounding it up also, so rounding it to $3. So that's our break even. So it doesn't have to move a whole lot to make it to our break even. So that's the good thing, you know. I mean, it's almost at one standard deviation move to the downside. We're well, one standard deviation move is likely going to get us that 50%, or sorry, 25% of our max profit. So, and like I said, to figure out where you would buy this strategy back, one of the easiest way to do it is to pull up your calculator. And if we have a $3 credit, you just multiply that times 0.75, and that gives you when you would buy it back, $2.25. Whoa, everybody kind of started going, what are the doing? Okay, now sounds good. Getting some echoing. Yeah, you might be getting some echoing. It's actually starting to rain here a little bit, so you could be hearing that too. No sound. Sounds in and out again. Lost voice again. Shoot. Hopefully this is recording well. Definitely take advantage of watching this over again. But see, this is where we're talking about. We want that $3. We want at least to collect over the width of those strikes. So I'm not going to, another one that I looked at that worked out, I'll do one more real quick and then we'll call it so I don't annoy you guys with it breaking in and out. No sound at all. Anybody else? What are some of the risks with this strategy and how is it different from the straddle? This is a defined risk strategy. So one of the things with the straddle is, you know, you're going to have higher risk. When you're buying that straddle, you need to have a much bigger move. By selling that in the money put and the out of the money put, you actually are reducing your risk by the amount that you of that straddle, but you're limiting your profitability. So in a sense, your risk is much higher by buying that straddle in a sense, and then you got to have a much bigger move. So this is a way to reduce some of that risk. But anytime you're reducing your risk, you're also reducing your reward in a sense. Does that make sense? Interesting, but no sound. Oh, it's killing me. But I'm afraid of losing my shirt. You're not going to lose your shirt, because if you're risking $3, or if you can stand to make $3, you're only risking $2. Okay. All right. So let's get to this. This is Floor Trader Hacks, you guys. So for 50% off, you guys can take advantage of this. This is invaluable knowledge that I learned on my 20 years on the floor, you guys. You get the 9 Floor Trader Hack video. It's shortcuts to all of this stuff, and will be invaluable in your futures trading. I mean, I talk about the different ways that you can use delta in your portfolio. Is that better now? Kind of played around with my mic. Anybody else not having sound? How's the sound now? Okay, great, good. So this is invaluable, you guys. These are 20 years worth of little hacks, shortcuts that you guys can use to implement into your trading regimen, going through and finding different nuances with the Greeks and finding ways to determine what the stock is going to pay in dividends and where that stock is going to have its earnings without even just looking on a chart or having to go to a different website to figure out when the different stocks are. I show you different ways to figure that out. I also show you how much you can expect like volatility to crush in a sense here, you know, this kind of thing. I tell you how to figure out how much volatility is going to crush. I also tell you what the likelihood of a move on that binary event is. All of that is within this, all of this is going to be in this series of options hacks, all right? The probability of you being in the money on a trade. So some of you guys were talking about doing long spreads. I talk about the probability of that strategy even working out. So I go through all of those rules in this. So this is really important stuff. And if you want to trade like a professional trader or a floor trader, which floor traders are some of the smartest guys I've ever met, even if they didn't go to college. Those guys are some of the brightest minds ever and have come up with a lot of these hacks and things of that nature. So here's your chance to basically trade like a floor trader in a sense, and all of the knowledge that we would use, because remember, you got to think fast when there's things going on, and these are ways to create shortcuts so you don't have to go through all the long math to figure it out. Also with this course, it's designed to produce consistent winners using these techniques, and it'll pay for itself over, you know, just a couple of weeks, just implementing these, probably even in the earnings season alone, just with all these volatility crushes and things of that nature that we're going to be going into, and how to determine where you need to put those, implement your strategies. The other thing is you also get unlimited access to me. You can write me. I have a no inbox policy for my emails. Reach out if you have a situation that a strategy is going against you, or something's not working out. You need to know how to manage that. I can go through what my rules are and how to stay mechanical with that. So take advantage of that. Also, the flip side of it is you get the daily market commentaries where I talk about every single trade I do, how I manage those trades. When they're going against me, I talk about the good, the bad, and the ugly, and most of the time I'm talking about the ugly, because those are the ones that take most of our focus. Those are the ones that we need to turn into winners, and I show you how to do that over the daily market commentaries. You know, I implement the strategy, it goes against me, I show you how to be mechanical and how to continue to fight that battle to get it back into profitability. So take advantage of that, and the link for this is in your chat box. It's not in what we're communicating with right now. It's in the chat window. It won't come up in the questions box. So just easily click on that. And if you've been watching this on tape because you couldn't necessarily hear me a little bit ago, then here is the link for that. It's basically floor-trader-hacks -4-options, all right, at ProTrader Strategies. You can just write that down. This is not an active link right here, but if you write it down or punch it into your URL, you'll be able to take advantage of this particular offer. Later webinars, we're going to be dribbling down on other option components, when and where I find trades appropriate. I want to thank you guys all for watching, and you can reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com, and take advantage of reaching out to me if you guys have any issues or anything of that nature. But again, here is that link for the ProTrader Strategies webinar or course here. Have a good weekend, Farshed. I hope we got the sound figured out. You'd like to use a strategy but afraid of losing your shirt. Oh, I think I answered that already. Trevor, you know exactly what you're risking here, and that's why you want to collect a bigger credit than you're risking, is because that's the way that you won't be risking your shirt. You know, you can lock this in. There's situations where if you lock it in for a debit, you would be losing your shirt because now you've locked in a loss and have no possibility of doing it. So take advantage of that for sure. This is a defined risk strategy, so you aren't going to lose your shirt with this one. And, you know, if you're implementing this strategy as a first timer, do it very small. Like if you're used to doing 5 lots or whatever, do it as a 1 or a 2 lot. If you're used to doing 2 lots, definitely do it as a 1 lot. And if you trade 1 lots, then do it in a paper trading account just to get used to it, right? Will you make money if the stock does not move like a straddle? If the stock does not move, you are not going to make money with this strategy. No. All right, that's all I got for you guys today. I hope everybody has a great weekend. If you can't take that, take it easy. A couple other questions just popped up. How much time do we have access to, when you're making your trades? Wait, I guess I don't. How much time do we have access to you when you are making your trades? I mean, my videos, if you're asking about that for the daily market commentaries, those are like 10, 15 minutes long. But you can reach out to me anytime throughout the day, Kirk, you know, because we could all have issues. I'm not necessarily on my email after the close by very long. You know, I usually kind of stick around and do some charts and stuff like that, look at different possibilities for the next day. But I'll try and get back to you as soon as I see your email, that's for sure. Does that make sense? All right, great. Yeah. So reach out to me, seriously. I mean, because I know people, when you're stressed out, you know, even if you just want me to talk you off the cliff, you know, please. Can I add let me see, Trevor, I don't know if I can add the membership link or not. I don't know if I have it on me. I think I have something else. The membership link should be in that chat window. Can you see the chat window on the breakdown over there? Yeah, there's a link in there for it for sure, Trevor. Just go over to the chat window, open it up, and click on that link. You're in Australia, 16 hours ahead now. How do I contact you? No, you can reach out to me, and as soon as I see your email, I'll reach out. I mean, you know, I'm working all different hours as well, so I can understand the rub there, but I'll try and get back to you as soon as I see your email. So click on that link over to the side, and you can reach out to us at trading@protraderstrategies.com. They'll forward you on to me, or you can call our phone number and we'll be in touch for sure. Sound good? All right, guys, have a great weekend. Take care. Sorry about all the technical difficulties. I'll try and see if there's a way to fix that. All right, take care.